December 26th, 2025, 9:42 a.m. Eastern Time. The silver market is open, but something feels off. The screens are lit, prices are moving, charts are updating in real time, yet beneath the surface, the market isn't behaving like it should, not like it always has, because this is not a normal week, and what happens next may not be reversible. Just 24 hours earlier, on Christmas Day, silver closed at $84.14 an ounce, a number that would have sounded absurd not long ago, the kind of price people would laugh at, dismiss, call impossible. But here's the twist. The price itself no longer matters. Prices can always change. They rise, they fall, they fluctuate. What matters now is what's trapped inside the market. Because while most people are still focused on charts and headlines, silver has quietly crossed into a phase traders fear the most. They call it Ghost Week. Ghost Week is where markets stop behaving politely. From December 26th through the first trading days of January, liquidity doesn't slowly thin out. It collapses. Market makers leave their desks. Risk committees shut down. Institutions freeze activity to protect year-end books. Liquidity doesn't fade by 10 or 20%. It vanishes, sometimes by 70%. Order books grow thin. Market depth evaporates. Spreads widen. Price discovery becomes fragile, unstable. During Ghost Week, markets don't bend under pressure. They snap. And this year, Ghost Week didn't arrive alone. It arrived carrying something the silver market has never seen before. As of Christmas Day, more than 145,000 March 2026 silver futures contracts were already locked in. That's 725 million ounces of silver, over $52 billion in exposure, frozen in place. And here's where the danger begins. Those positions can't be adjusted, not hedged, not rolled, not unwound. They are locked, frozen in time. Now ask yourself this. What happens when tens of billions of dollars in exposure are trapped inside a market that already struggles to deliver physical metal at the exact moment liquidity disappears? In a healthy market, this never happens. Ahead of holidays, traders reduce risk. Open interest falls. Positions unwind. Exposure shrinks. That's how markets survive thin trading conditions. But this year, the opposite happened. Open interest didn't fall. It surged. And the reason tells you everything you need to know. Industrial buyers couldn't step away. Solar manufacturers don't shut down for the holidays. EV assembly lines don't pause. Electronics factories don't take vacations. And their silver demand doesn't either. This is where the old models break. Silver demand is no longer optional. When prices rise, factories don't stop production. They absorb the cost, margins compress, budgets strain, but production continues. Because this isn't jewelry demand. This isn't luxury consumption. This is infrastructure. And infrastructure doesn't wait for January. What you're seeing now didn't begin this week. It didn't even begin this year. For 7 straight years, the silver market has been running a structural supply deficit. Year after year, the world consumed more silver than it mined, by more than 670 million ounces. That gap was filled by inventories, vaults, stockpiles, strategic reserves, until they were gone. Today, registered inventories are thin. Lease rates remain elevated. Physical premiums refuse to come down. There is no secret cache of silver waiting to flood the market. No emergency reserve, no safety valve. And beneath all of this lies a deeper issue most people still don't understand. Silver supply is fundamentally inelastic. Roughly 70% of global silver production comes as a byproduct of copper, lead, and zinc mining. You can't just decide to mine more silver. To increase supply meaningfully, you need entirely new base metal mines, projects that take 5 to 7 years to bring online, assuming everything goes perfectly. So when demand rises suddenly, supply doesn't respond, price does. And demand isn't slowing, it's accelerating. Solar installations keep expanding. EV adoption continues climbing. Electronics consumption grows every year, but the most overlooked driver is unfolding quietly inside the solar industry itself. TOPCon technology. TOPCon solar panels use roughly 50% more silver per unit than previous designs. And the industry isn't switching because it wants to. It's switching because it has to. TOPCon panels are more efficient. They last longer. They meet tightening global regulations. Manufacturers don't get a choice. Solar demand alone is growing around 15% per year. Global silver mine supply, less than 1%. That gap isn't temporary. It isn't cyclical. It's structural. And now comes the final layer most investors still haven't fully absorbed. Silver is no longer just an industrial input. It has been officially designated a critical mineral by the United States. That designation changes everything. It means silver is essential to energy infrastructure, military systems, national security. And when governments enter markets, they don't wait for pullbacks. They don't negotiate. They buy regardless of price. That introduces yet another source of inelastic demand into a market already stretched to its breaking point during the thinnest liquidity window of the entire year. This is no longer just a price story. It's a structural collision. And once markets like this break, they don't reset quietly. Now the story shifts. Because this is the moment where theory ends and math takes over. This isn't speculation anymore. This is arithmetic. During Ghost Week, industrial buyers tried to secure contracts and couldn't. The phones rang. The orders went in. But the market wasn't there to meet them. Those orders didn't vanish. They stacked up. Demand wasn't destroyed. It was delayed, compressed like a spring. And when markets reopen, likely around January 2nd, that demand doesn't return gently. It doesn't trickle in. It hits all at once. It crashes into a market that's already fragile. Thin liquidity, elevated open interest, massive short exposure. This is where pressure turns into force. This is where the squeeze begins to show its teeth. As prices move higher, something mechanical kicks in. Margin requirements rise. Every dollar higher in silver demands more collateral from anyone holding short positions. At first, they post cash, then more cash. But eventually some of them can't. And when they can't, there's only one option left. They must buy. That buying pushes prices higher. Higher prices trigger more margin calls. More margin calls force more buying. This isn't a theory. It's a feedback loop. Buying creates higher prices. Higher prices trigger margin calls. Margin calls force buying. And suddenly, price doesn't move in steps. It moves in jumps. With 725 million ounces of exposure trapped inside the system, even small moves carry enormous consequences. A $1 move isn't just a dollar, it's a shockwave. Small dislocations become systemic events. And here's the part most people misunderstand. This isn't retail traders chasing momentum. This isn't social media speculation. The positions trapped here belong to institutions, commercial hedgers, banks, industrial users, producers. These trades were entered under one assumption, that markets would function normally, that liquidity would be there, that exits would exist. Those assumptions are now broken. Liquidity doesn't return overnight. January trading begins thin. Volatility stays elevated. Risk managers remain cautious. And when exits narrow, moves become violent. Could this unwind quietly? In theory, yes. In reality, no. Because industrial demand cannot step aside. Solar panels still need to ship. EV factories must keep running. Electronic supply chains must deliver. Silver isn't optional. When demand is non-discretionary, price doesn't gently ration consumption. Shortages don't end politely. They end when prices rise high enough to force someone to stop using the metal. That's why timing matters more than price. This setup exists because three things happened at once. Liquidity collapsed. Exposure froze. Demand never stopped. This window won't last forever. Once positions unwind, once prices gap, once inventories change hands, the setup disappears. But the repricing doesn't. Markets under this kind of stress don't drift back to equilibrium. They gap. They overshoot. They shake confidence. They punish anyone who arrives late and unprepared. This isn't about predicting a specific price target. It's about understanding dynamics. When forced buyers collide with thin supply, price is no longer negotiated. It's discovered, violently, and make no mistake, this won't be smooth. There will be pullbacks, engineered sell-offs, sudden volatility spikes. Paper markets always fight to survive. But volatility isn't weakness. It's stress revealing itself. And that stress is building. So what does this mean for you? This isn't about day trading. It's about exposure. Physical silver removes counterparty risk. Mining equities offer leverage and volatility. Paper instruments depend entirely on trust and settlement. Choose accordingly. Because the window is narrow, most people won't notice what's happening until the headlines start screaming. By then, liquidity will be gone. Prices will have already moved. Optionality will collapse. That's how asymmetric trades work. Quiet first, violent later. This isn't a prediction. It's a setup already in motion. A structural deficit, frozen exposure, inelastic demand, and a guaranteed liquidity vacuum. The only unknown is magnitude. Because when markets reopen, they won't be negotiating with theory. They'll be reconciling reality. And reality is unforgiving. If this helped you understand what most people are missing, like the video, share it, and subscribe. Because this story is unfolding in real time. And when liquidity finally returns, the market won't ask for permission.